Hello again, and thank you for joining us. This is the Feud podcast. I'm here with my co-host, Madison Evans. Hi, Madison. How you doing?
Hi, Rob. I'm good. How are you?
It's great to be back. We got a bonus edition we're going to talk about.
Yes.
All of what's in the news right now. I think that's most important. You've got some key questions. I think our audience is really, we have a lot of clients that always ask them, sort of Q&A, frequently asked questions as well, and they're concerned about the headlines. And so what we want to do, our goal here is to strip out what the headlines are, what matters most to your money, what matters most to the markets. That's what's key right now. That's what we do in our job every day, is to be sort of that filter as we invest our clients' money to make certain that we're not distracted. Mm-hmm. And, there's always market volatility and there's always geopolitical unrest. It doesn't matter whether it's today, tomorrow, some point in time in the future. But if we just look at history as our guide, markets climb a wall of worry, and that's sort of where we are today. It doesn't change. But let's go through some of the key topics that we want to talk about today that are definitely on everybody's mind.
Yes, I will kick us off starting with the big, beautiful bill, which has been in headlines a lot recently, especially with the public feud between Trump and Musk last week. But can you share with us what your thoughts are on the bill and its implications on the national debt, consumer sentiment, and bond yields?
That's a loaded question, and there's a lot in there, Madison. You just start right out of the gate. I love that. Let's go to, take a step back to the President Trump's administration and the three initial strategies right out of the gate. Okay. Mm-hmm. President Trump was elected on President's Economic Foundation. What he basically presented for a foundation of sort of economic prosperity for America are three things to get us there. Mm-hmm. Number one, he wanted to deregulate, and he did that basically day one in office. And he's continuing to do that through the big, beautiful bill and continuing deregulation, opening up energy independence, unleashing the ingenuity within the United States on multiple sectors and multiple levels. So deregulation, there's a lot of red tape. In Washington, there's a lot of red tape on the municipal level in each individual states. But if you look at sector by sector, let's say energy as an example, the energy consumption, not only in the United States, is growing exponentially and around the world. The reason why that is not because we're driving more, we're either choosing between an EV car or, traditional fossil fuels as we go through as consumers. It's really the AI in basically adoption. And by that, I mean, think about this. The AI adoption is data storage. So we need storage facilities, and the amount of power that's needed to generate all of that, and then the cloud computing where they store it. That is really going to, if you look at the economic forecasts, it's going to put a major strain and drain on major countries that are adopting this. And so the idea is this is not a discussion of energy, which was better than the other. The reality is, if you look at the numbers, all of the above, we need all hands on deck in terms of all energy to help fund or at least meet that energy consumption need, both here and around the world. So one of the things was in the energy sort of sector was deregulation. So deregulation is number one. Trump already hit that out on day one. Number two is the tariffs. So we talked about this in previous episodes, but the tariffs are, without the history lesson, but going back originally, we didn't have tariffs. And now they switched it in the turn of the century in the United States, and they went from 45% tariffs to now 2% tariffs on other countries importing their goods to sell to the U.S. consumer. And by the way, the U.S. consumer is the number one consumer that every global market wants access to, right?
Right.
But to have their goods and services imported into the United States, it's only 2% tax. Mm-hmm. If you look at your grocery store, that grocery store sells to all of those companies their shelving space, and they put a tax on that, or an opportunity to be like, you want to be at eye level, let's say for anywhere from cereals to soda. Well, that's going to cost a premium because they want access to the consumer. So from a grocery store standpoint to the United States, access to the consumer, there's a cost for that. And we shouldn't be subsidizing that out of pocket to say, okay, come on and sell anything to anybody, and you don't get to you get free access to all of our consumers. So the idea was the tariff. So if we're at 10% or 20%. I know there's a lot in the headlines right now.
Yeah.
I think we're going to get somewhere higher than where we are today.
Right.
Why that matters is it's going to help our deficits and our debt. The United States has a huge deficit and a huge debt. And so we have to control that, or at least pay attention to that. And that's a major factor here. And the third thing is the tax bill, the big, beautiful tax bill. Now, if we continue down that vertical and say, okay, well, all that sounds good, right? We want to deregulate. We want to open up business ingenuity. We want to give tax incentives to small business owners. We want to extend the basically the tax cut, because if we don't do anything right now, it'll be the largest tax increase on U.S. consumers ever recorded.
Right.
So something has to be done on this bill, and something we believe will be done. The challenge, and this is where Elon and President Trump don't see eye to eye anymore. They were besties like 2 weeks ago. I don't know what happened, but essentially they're not best friends anymore, right? And when I was interviewed on Bloomberg, actually on June 5th, that day, they asked me about, obviously talk about what happened in the markets, what's relevant, and what's in the news cycle. And that's when that whole sort of riff really escalated and basically took off. They were back and forth probably 6 or 7, 8 times on each of their respective platforms. And they got personal, which is, no one needs to see that. That was very ugly very quickly, and it escalated very quickly. But the take home point was how Elon Musk was saying, hey, you're all about what I just did in terms of Doge. I just spent the first 100 days looking at cutting government waste and spending. And now the bill that's proposed is about a $5 trillion bill.
Right.
That's bigger than any other bill we've ever passed, bigger than what we've done in COVID. So you can't basically ask me on one hand to do my job, and on the other hand, you're not being basically respectful of like everything, all the good work that I've done, because you're just putting the United States in bigger debt. Right. You're not solving the problem. In fact, what you're making light of what Elon Musk just did in his Department of Doge by really not understanding sort of the bigger picture. And why that's a real issue is because we can't afford the debt levels and the spending and so on and so forth.
Right.
And ultimately that has to be addressed. And Elon Musk and President Trump are on the same side. They're saying the same thing. They're just sending a message vocally and verbally to Congress. And you know how sausage is made. You know how that they pass a bill. And this is the reform that really needs to happen in Washington. They need to basically not say to all the senators and Congress people and House of Representatives, like, oh, by the way, this is a 6,000-page bill, and you have 1 hour to read it, and the next hour you have to vote thumbs up or thumbs down. Right. That is absolutely ludicrous. That's not even right. And in fact, that's what Elon Musk called out too. Yeah. And then so he actually sort of threw gasoline on the fire, right, by a lot of the personal jabs and barbs that he did. But he brought the attention to the issue. And oh, by the way, Trump ran on a smaller government. Trump ran on, let's make certain that we're responsible for the taxpayer money. They're both on the same side. They just got to, a little personal. But you're seeing today in today's news right now, Elon Musk is now sort of backtracking. Wherever that relationship goes, what I said in Bloomberg was the only one person that I believe that could probably solve this would be just have Joe Rogan sit both of them down in the podcast studio for 3 hours face to face and just hash it out, right? And just say, hey, listen, no one's leaving until we're all friends again and we apologize. So that's number one, what Joe Rogan can do. And if that doesn't work, Joe Rogan's still the man. He then can opt for the octagon. Let's go to put these two in the octagon. We'll sell UFC fight tickets. And I think that would be the ultimate sporting event ever in the history of sporting events. I think that would blow away Super Bowl viewership. That would be crazy. That'd be fun. I think that's a good idea. They should get on. It's what we need because, it's like two kids in a schoolyard. Let's be responsible adults and let's get back to the issues at hand and keep all of our personal stuff out of it. Mm-hmm. So moving forward with the bill, do you think that the worries about it increasing the national debt are real, or do you think that it's going to be changed so that that's not as much of a worry? Absolutely real, absolutely validated. Mm-hmm. The spending is going to happen. It might not happen at the level that has been called into question at this moment. Mm-hmm. And ultimately, on the flip side of that, there is a lot of good. So there are a lot of pro-growth incentives for families, single moms, small business owners that say yes. And here's one of the reasons, in theory, and it's worked in the past. Reagan did it so greatly, where he reduced the taxes, the amount of taxes that we pull in, and he allowed you and I and the small business owner and the individual in the United States to decide where they're going to spend their money. And they're also going to say, hey, let's lighten the load because we want to unlock the ingenuity and basically the engine of America to grow again. So why is that important? Why should we care? Right now, we've got about a 2% GDP, gross domestic product. And essentially, it's just all the goods and services in the United States. And think of it like a pie. Mm-hmm. And so historically, we've seen a 3% GDP. Okay. So going from 2% to 3%, what does that mean? Why do we care? For every 330 million Americans right now, if the GDP went from 2% to 3%, that's an additional $26,000 of wealth for every single person in the United States today. It's such a wealth effect on every level, and it's such a relief. Americans need relief right now. So on one hand, you say, okay, we can't afford the debt. But at the same time, what if we were to unleash growth and grow the economy so much that now we have more spending, now we have more taxes, we have more to fill the coffers, and that growth will eventually take care of it. And we could see lower interest rates later this year, which then helps on the debt servicing, which is another issue.
Mm-hmm. You kind of covered it already, tariffs, but moving on to that, we got news of progress on that this morning, and markets are up. The news was that U.S.-China trade negotiations in London have progressed significantly with framework for a trade deal announced. This morning, President Donald Trump stated our deal with China is done, subject for final approval with President Xi and me, claiming the U.S. would secure 55% tariffs while China would face 10%. I want to get your thoughts on that and where you think that's going to be moving forward. Do you think this is the final trade deal, or do you think there's still going to be negotiations?
As we said at the very beginning of this episode, that's what matters.
Right.
China is the second largest economy in the world. They're a significant trading partner. Mm-hmm. There's a significant, it's been called out, imbalances that want to be rectified by the United States in tariffs. And so, like I said before, China is sending all their goods over here to the U.S. consumer. And let's go back to the first Trump administration when he tried this. He put $300 billion of tariffs on China day one. Mm-hmm. All 4 years through his policy. And then we have President Biden. President Biden looked at the budget and the deficit and the debt basically and said, we can't afford to take off that $300 billion off of China in tariffs. So President Biden left them on. Okay?
Right.
And so we have 8 years of a test case of tariffs on China. And oh, by the way, they didn't back down and they didn't try to restructure it when President Biden kept it on there, right? Mm-hmm. They didn't say, let's go back to the trading table. They just said, okay, that sounds good. That sounds fair. That's interesting. So if you look at the goods and services under both in the 8 years, there wasn't significant inflation based upon those tariffs. Mm-hmm. So we already have a test case of, will it be inflationary to the kitchen table? There will on the short term, and that's what markets care about, is it long-term inflationary? Like we saw earlier this year, eggs, super inflationary. There was a lot of issues as to why. But does the market care about that? Consumers do, you and I do. But that was a short-term issue that was resolved. And I think that's what I think I want our audience to understand is that the markets care about the longer-term implications, not short-term flare-ups.
Right.
If it's longer-term, let's call it, if the big, beautiful bill doesn't get approved and we have the largest tax increase in history on the U.S. consumer, our economy's dead.
Right.
You and I, no one's spending money. It's over. It's over. We're literally going to have our GDP go from where we are to shrinking our economy. Mm-hmm. If the market smells that happens later this summer and Congress can't decide, that's what markets care about. Do they care about the price of eggs? No, you and I, that's called inflation, right? And oh, by the way, the CPI report came out this morning about inflation, and that's actually trending lower. And that's a really good sign because, again, that helps the Federal Reserve consider later this summer, maybe early fall, the ability, it provides cover for them to lower interest rates.
Right. And that leads me into another question I wanted to ask you. Is your outlook for Fed policy for the rest of 2025, do you think that they'll be able to lower rates at some point this year?
I do. I think we will see that. I think we have, you remember the Fed has two mandates and they're equally balanced and they have to decide what's more important than the other based upon the current data that they're looking at and the state of the economy and the state of the consumer. And that is labor market, making certain that we have full and maximum employment, as well as inflation, that inflation doesn't get out. So they're spending their time looking at inflation right now because inflationary prices that we just described could be going up. So they have to keep this. We don't want to go back to the late 70s, early 80s.
Right.
That was a hit to every consumer, everybody. You can't hide from that. So they're doing the right thing by taking their time, basically higher interest rates for longer. Now, with the inflation report that we got this morning and the trend that we're seeing down in labor market, housing sort of slowing, and we see all the positive trends, and the labor market is sort of staying right where it is right now. It's not going down, but it's not increasing. The Federal Reserve can now switch from the left hand to the right hand on their other mandate, which is say, okay, how's the U.S. economy doing? Do we need to help out? And if so, let's make it happen.
Okay.
By lowering interest rates.
Yeah, love it. Another thing that's been in headlines a lot recently and is pretty close to us in California is all of the riots in LA. Do you think that that's important to watch with markets? Is it going to affect markets at all?
Yeah, what I'd like to say is if you look at what the market did earlier this week, very specific, you had the markets opened lower on what's happening in LA on Monday. But quickly, intraday, within a couple of hours of trading, turned around. And the market ended up higher as a result. And what was the number one thing that mattered to the market was the trade talks were advancing. They agreed to continue having further talks. They didn't resolve anything, but the headline that came out of London of the two parties sitting down was, good first day, we're going to continue to day two. And as soon as the markets heard that, they turned right around. So while it's a tragic event that we're seeing and it's like a vacuum. It's capturing everything that we're watching at night. And it's very scary. And it's really sad to see what's unfolding that could even happen. Right. Markets are paying attention to, like I said before, what's really matters is the economics of the globe and what's happening here in policies in the United States. Why? Because if LA turns into, it's just days right now. And so that's what the market is interpreting, days. If it turns into weeks and months and then spreads across the United States, that's when we could have a shift in the sentiment of what the market's paying attention to. But in the short term right now, the bigger headline, the only headline that really matters are tariffs, trade talks, and the tax bill that's working its way through Congress.
Okay. Last question. Your Bloomberg interview last week, you said that the word you think will be used to describe this year's market is resiliency. How come you chose that word? Yeah,
so the number one word that you're seeing right now in every single corporate earnings conference call, because we look at the corporate earnings conference calls as well as not only earnings releases, is the word uncertainty, right? If you're running a company, big, small, in the middle, you don't know for the first 6 months of this year what you're dealing with. We have uncertainty in trade policy. We have uncertainty in tax planning, so on and so forth. But I said on Bloomberg, we're going to shift, or it's going to be resiliency. It's going to go from uncertainty to resiliency because the economy is going to see a soft landing. We're going to see support by the Federal Reserve. We're going to see a lot of positives, I believe, in the second half of this year, like the tax bill to be extended. To what extent, we don't know. But if you're a small business owner, there could be a lot of incentives in that bill that say, hey, listen, retroactive 2025, January 1st, you have the ability to buy something new for your business, whether it's a printer or something bigger, and you get 100% accelerated depreciation on your taxes. What that means is that that's going to start incentivizing everybody in the United States to say, okay, let's start, if you and I are competitors in business and I start investing in my business on any level, and you see that I'm doing that because I'm going to take advantage of the tax advantages in this year and years going forward, you have two choices: either sit and watch or say, hey, wait a minute, I'm going to start doing that too because I don't want to be left behind. But think about the power of that magnifying throughout corporate America. And that's exactly what's going to happen. And that's why it's so important. We will see the change in the tax law, but we will see the unleashing and unlocking of all of that sort of competitive spirit. And so we'll see sort of that could add some additional fuel to what we would say is a resiliency of the U.S. economy, because we were waiting for everything. Did tariffs take the economy down? Well, the uncertainty certainly did, because it took it down to the markets in the first week in April. But that turned out to be, in the short term, a buying opportunity for long-term minded investors. And that's what we did for our clients.
Yeah.
And took advantage of. We love to basically shop when things are on sale with high quality, basically those that are compounding cash cows for our companies or for our clients. Those are companies that really should be trading where they are, but you take advantage of the headlines. And that's why it's so important that we said earlier in the episode, which is the headlines, what matters. It's the trade deal with China, right? Because it's a big partner that we need to basically figure out how we could see eye to eye, and we won't see eye to eye, but where can we at least agree to disagree? And at the end of the day, let's get a deal done and move forward. So there's some certainty.
Right. Congress,
get a deal done so we can move forward. There's some certainty. And then in the meantime, the U.S. economy is kind of like holding on. There's the resiliency that I'm talking about.
Right.
Because if we get all these great benefits at the end of the year, Federal Reserve lowers interest rates on top of everything I just described,
right,
you could see sort of everything working together again in the right direction.
Okay. Love it. I know I said that was my last question, but I actually have one more.
Shoot, go for it.
Going into the second half of 2025, are there any specific themes that you're excited about?
Yeah, we love looking at thematics, like themes that are sort of resilient as it relates to the economy. Because, we could have, economy in any given year or multiple years where the economy slows, right? Whether it slows, soft landing, or recession. And then we could have any given year or a couple of years where we have a raging bull market because of all of the incentives and all the things that we just described. But let's say we don't know which we're going to get.
Right.
So that's where the thematic investing for our clients, we always look out for. And we add this into the portfolio as a sector and a theme to take advantage of. Let me give an example. Cybersecurity. So it's one of the biggest growing markets out there, number one. And regardless of if the economy is in a recession and corporate earnings are declining, or if it's the opposite, everything's growing on the other side. If you're in a boardroom, you and I are in a boardroom, and we're scheduling and we're forecasting and we're putting together our budget for 2026, 2027, and the IT guy says, oh, by the way, I need a 10% increase in my cybersecurity spending. Who in the room, even if the economy and the company's slowing and the economy's going down, who in the room is going to disagree with their IT guy about decrease in cybersecurity spending for their company?
No one ever.
Zero.
Yeah.
So that's one of those themes that we know is growing regardless. That has to be spent on, that has to be taken seriously by small and large companies. And if you follow the money, and we always follow the money when we're investing, that's one of those that's recession proof in our mind. That's what we believe. So we love that sector, which is cybersecurity as a theme, because it keeps us insulated. Another one coming into this year, we follow what Washington's doing, what the administration's doing. One of the major key tenets that the Trump administration said was aerospace and defense. So we love defense. We've always had it in the portfolio, but as a theme, there's a diversified bucket of defense spending that we can add into clients' portfolios that provides us the exposure to that asset class where you can then follow the money. When Congress decides to reallocate some money, and they're already talking about in this bill that's going to be passed later this year, increase in defense spending like we've never seen before. Well, who's going to benefit? Those companies in the aerospace and defense sector. So that's another theme to answer your question that we like.
Love it. Love those themes. Well, thank you for all that information. I think
it's our pleasure. This has been fun.
Yes, and thank you everyone for watching this episode. Our next episode will be season 2, episode 12, featuring Lori Cree, and you will not want to miss that episode. As we close every episode like this, I have a couple quotes. The first is by Albert Einstein. Life is like riding a bicycle. To keep your balance, you must keep moving. And our second quote is by Franklin D. Roosevelt. If civilization is to survive, we must cultivate the science of human relationships, the ability of all peoples of all kinds to live together in the same world at peace. Again, thank you everyone for listening. Like, subscribe, and share this episode with someone that you think would like it. And look out for our next episode of the Feud Podcast.
This podcast is brought to you by David Field, producer. It is produced and directed by David Field and Kristen George. And it's mix, edit, and socials by Kristen George. Schein Wealth Management is a group of investment professionals registered with Hightower Services, LLC, member FINRA and SIPC, and with Hightower Advisors, LLC, a registered investment advisor with the SEC. Securities are offered through Hightower Securities, LLC. Advisory services are offered through Hightower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinions, news, research, analysis, prices, or other information contained in this research is provided as general market commentary. It does not constitute investment advice. Schein Wealth Management and Hightower shall not in any way be liable for claims and make no expressed or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements or errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This document was created for informational purposes only. The opinions expressed are solely those of Schein Wealth Management and do not represent those of Hightower Advisors, LLC, or any of its affiliates.